There are so many misconceptions around the infinite banking concept, and I am here to destroy all of them. Why do you ask?
I am inevitable.
I'm just kidding. Nelson Nash, the founder of the concept, was revolutionary to the insurance industry. And to be quite frank, I probably wouldn't be here right now if it wasn't for him. But I do care about every single person getting a permanent insurance policy and that they know the truth. So I am here to eliminate any hard left-wing infinite bankers who are misleading, misinforming, or just not sharing the truth. So today, I'm going to share with you myths around infinite banking and what's really going on underneath the hood. Infinite banking myth number 1, the one you probably hear about the most, the one you probably get the most excited about, and the one you probably get the most confused about at the same exact time. You pay yourself back interest. It sounds amazing. You pay yourself back interest that you were charged? Whoa. It's like a magic genie lamp. But the truth is, this is either A, misleading, or B, a lie. The fact of the matter is, when you get charged interest, that interest goes back to the insurance company. Here is the language in an actual insurance contract that says it clearly. Any interest that is not paid at the end of the policy year is added to the loan balance, which will also be charged interest. Interest that you pay to us is not credited to the cash value of the policy, and it does not increase the cash value of the policy. And notice that interest that you pay to us is not credited to the cash value of the policy, and it does not increase the cash value, is in bold black letters. The infinite banking marketer can be so frustrating sometimes because I know what they're doing. When they say you are paying yourself back the interest, they are getting the consumer extremely excited, which it is great marketing. Who doesn't want something that pays you back interest when you borrow against it? But in reality, it's just flat out misleading. And if they are being misleading intentionally or not, what they really mean is you pay the insurance company back interest. And when you do, the insurance company becomes more profitable. And when they become more profitable, you get a higher dividend. While this is true, when the insurance company becomes more profitable, you get a higher dividend. This is misleading because 1, they don't just flat out say it. Just say it, which is unethical in my personal opinion. And 2, in reality, which nobody ever talks about, if you don't take a policy loan, the insurance company would likely be more profitable. You may ask, how is the insurance company more profitable when you don't take a loan against your policy? Well, you see, every time you take a loan against your policy, someone in the home office of that insurance carrier has to take that transaction, which is the cost of doing business. They would much prefer you leave your funds alone so they don't have the transition costs. But most importantly, they want control over more money. If they control more money, they can go out and invest it, and quite frankly, just do more with it. By lending it to you, they lose that control. Here's an example of how life insurance companies use control. Listen up, because this is important. Because you can take a page and follow the money, and life insurance companies have lots of it. When you pay the insurance company premium, it goes into their big pot of money. They now have control over those dollars. And when you take a loan against your policy, those funds leave their control and go in your control. So if the interest they charge you is 5%, that is the most that they can earn since they no longer have control over what they lent you. If you don't take a loan, they have full control over those funds, and they can go get a higher rate of return somewhere else than what they're lending you the money at. So if the interest rate is 5%, but they could go get 8% somewhere else, that is a 3% spread that they are missing out on. So let's use an example of how this can be applied in your life. You have a line of credit, could be a HELOC, business line of credit, loan against your brokerage account, or of course, your life insurance policy. The loan rate to borrow from your line of credit is 5%. You have an opportunity that is 7%. Do you borrow at 5 to make 7? Math logically would say yes, all day. But let's talk about control if you borrow at 5 to go earn 7. What did you just do? You locked up those funds in a 7% investment and no longer have control, which means you no longer can take advantage of an opportunity that earns you 20%, or have liquid cash available if your business is about to go under. Control is undervalued in finances, and we need to put more emphasis on it. Infinite banking myth number 2, you should funnel all of your life expenses through your insurance policy. This one makes me cringe every single time. I would like to ask you a question. If I said, hey, every time you went to the grocery store, I will charge you interest interest to buy groceries, what would you say? You would likely say no thank you, which obviously makes sense. Well, again, we must remember when you borrow against your policy, you are being charged interest. You are naturally creating a drag on your policy. Infinite banking myth number 3. You should use your policy to purchase vehicles. I have friends and colleagues in this space that are preaching this all the time. I get where they are coming from, but in my opinion, it depends. Although I would say no more than yes. Let's start with the fact that we all need transportation in today's society. If you have no money in your bank, you can't get a loan from the dealer, and you have a life insurance policy, well, yes, you need a car. Borrow from your policy to go get that bad boy. But if you can get an interest rate from a bank or a dealer lower than your policy, it would make more sense because you still have control over your dollars if the goal is to build wealth. Most infinite bankers will heavily disagree with me when I say you shouldn't use your life insurance policy to purchase vehicles. And I understand their rebuttal, which is there's this thing called lost opportunity cost. And when we spend $1, we never get that dollar back. And we lose out on what that dollar could have earned us for the rest of our lives. And you also pay simple interest to your life insurance policy loan when you pay it back within the first year. All true statements. But hear me out, infinite bankers. We talk about lost opportunity cost all the time, but when we are using our dollars to buy expenses such as vehicles and groceries, what are we missing out on? We are losing the control of our dollars to go buy income producing assets, which in my opinion is losing out on even more opportunity cost. We underestimate the power of control. I'm going to spit some bars and drop the mic here. And I know some agents will disagree with me, but you as the owner of the policy will not get wealthy from an overfunded whole life insurance policy. And I sell it for a living. So take it for what it's worth. You will be much better off if you have a life insurance policy that is cash heavy focused than if you don't. But this is not how you build real wealth. So you may ask, how do you build real wealth? Well, you increase your cash flow. You buy assets that produce more cash flow, such as real estate, or you invest in your business or invest in yourself to increase income. If I lock up my money at 5% to go buy a vehicle, that money is no longer available to increase my income by 100% by putting it back into my business or learning a new skill. So using my policy as a tool to build wealth is the name of the game. The activity that you produce when you borrow against your policy, that is how you build real wealth. Oh, don't forget, your death benefit can be passed down to the next generation, just like the Rockefellers do. That is how you transfer real wealth. An infinite banker could come up with a good argument that you should use your life insurance policy to buy vehicles, but at what expense? To save a little bit of interest and stay in the middle class? If that is your goal, then I would say Dave Ramsey is your man in my opinion. Infinite banking is really a mindset, and I want to take that mindset to another level. Let's build wealth and increase value versus saving a few dollars in interest and changing how we buy expenses. Infinite banking myth number 4, and this is really going to upset a lot of infinite banking advocates. You should always have a standard 40-60 split policy. What this is saying is that you should have 40% go to the base and 60% go to the paid up additions. In the simplest explanation, the base is the foundation that makes it insurance. PUA is an add-on that makes it grow cash heavy. If you advocate that the goal is to replace the banking function, that would mean that cash is your number one priority. And if that is the case, you would think you'd want to maximize the cash component. And if PUA is a supercharger of that component, why wouldn't you want as much of it as possible? 40-60 base to PUA ratio was recommended in the book Becoming Your Own Banker by the Nelson Nash, which I think is a fantastic book to start the mindset shift. But times have changed, innovation has occurred, and I do believe if we are writing policies for 60-40 focusing on cash value, this does come down to agents focusing on higher commissions. Oof. That hurts. Because I have heard agents get upset and clearly state it is not about compensation. And maybe they truly do believe that. But facts are facts. The higher the base, the higher the commission is. And the more the agent gets paid, the less cash value you have. I will always leave the conversation open for it depends, because hardly ever are there any clear, real black and whites. So I'd love for an agent to reach out or in the comments when focusing on cash value, a 40-60 makes sense. I have never seen a content creator be like, here's a 40-60 and this is why it's better. That's honestly all I'm asking, so I can learn just like everyone else. Because I know for a fact I don't know everything, and I will keep learning till the day that I die. Finally, myth number 5 of infinite banking: you must avoid banks at all cost. Again, I understand the idea of eliminating banks because you want control and you want to mimic what the banks do, but let's be real clear here. When you borrow against your life insurance policy and request a loan, those funds go directly to your bank account before you can use them. So you must have a bank account to get started with the concept. Also, in these life insurance policies, there's lots of liquidity, but it could take anywhere from 1 to 5 business days to get access to your funds. But what happens if you need cash in the next 15 minutes? Your policy can't help you with that. Lastly, banks have a really good functionality giving you access to more money at a very cheap cost. Banks should not control your life or your finances. They should be used as a tool to help you build wealth, just like your life insurance policy does.